What are you sort of sensing and hearing from them as they prepare for next year, particularly this idea as well on the labor front, and whether they start to have to focus on cutting costs?
Dave, first of all, thanks for having me. Great question.
Of course.
So, obviously in the boardroom, everybody expects 23 to be bumpy. Hard to figure out how it's not. Everybody understands inflation must be tamed and tamed urgently. That said, for the most part, a lot of boards are saying if 23 is bumpy, we have it, but what does the other side look like? How do we prepare for what 24 might be, what a recovery might look like? And there, I would tell you that I think you're going to see companies be quite a bit more offensive than you've seen in past downturns. If there's anything we learned from March of 2020, making decisions nimbly, staying on offense, figuring out where you're going to invest is important. So even on M&A, it's not obviously an active time, but it's more active than I would have bet given the economy, and much different than you would have seen 14 years ago in this kind of backdrop. So I think for the most part, you have a lot of CEOs, a lot of board leaders who are very good about taking information in, recognizing that the data is mixed, processing it, developing and updating their thinking on a real-time basis, and adapting to it. I mean,
so what's the updated thinking, though? I mean, at this point,
the updated thinking today is the economy in the U.S. on a relative basis actually has tailwind and headwind, but it's not all headwind. Okay, you have a consumer still spending. You saw Visa this morning.
Yep.
You have banking system in good health, credit obviously tighter, but in good health. You have labor still tight. I would say that for the most part, jobs are fewer than labor availability, going to change, but and then the markets are actually pretty settled in. So the thing is, everybody says 23 will be bumpy. It will be.
Right.
But the question is the duration. And today,
we don't know.
We don't know.
How can we?
And that's the point.
But do you prepare for it as a corporate leader by thinking now, as you're going to get pressure from shareholders to increase margins, by saying we're stopping hiring, or even, in fact, we're going to actually let people go? Or is that a different conversation now, in part because sort of after COVID, what the labor markets have presented in terms of how difficult it's been to get people in the first place?
That's the big test. I think that companies, for the most part, are going to be disciplined in cutbacks. They're going to recognize that they don't want to sacrifice the long term for short-term moves. Obviously, certain companies hired aggressively to handle demand over the past few years. But the fact is, labor, maintaining labor, training labor, mentoring is hard. So I think that you're going to see OPEX areas, operating expense areas, continue to cut back. But it'll be like advertising. It'll be things that seem more short-term. If you're thinking longer-term, 2 years, 3 years, 5 years, you want to think strategically. And that, to me, says you're going to keep spending capital.
Right, but that also could be margin compression in next year is what I'm hearing.
And that, I would say, the best companies for next year, the most competitive companies, are going to figure out how to maintain a decent margin and have a fortified financial situation, fortified balance sheet, and again, make moves, David, that position them for a better long-term future.
Yeah.
Shepard Smith here. Thanks for watching CNBC on YouTube.